What does the latest news mean for the Reserve Bank and our interest rates moving forward? It's possible the Reserve Bank may be forced to raise interest rates because of the latest employment data. We're going to be discussing that, house building costs, and the increased confidence of buyers now getting back into the market in this week's Property Insider Chat. If you want to keep up to date with what's happening in our property markets, please subscribe to this YouTube channel and click the little bell icon so we can let you know each time a new show comes out. The media is full of speculation about what's ahead for interest rates. Of course, Dr. Phillip Lowe, the Reserve Bank and Federal Treasury attempt to work together to create an ideal economy, one with low inflation but one that's chugging along nicely and has low unemployment. And the Reserve Bank does this by lowering interest rates when it wants to boost the economy and when it wants to increase inflation, like it did a couple of years ago during our pandemic. And it raises interest rates to slow the economy and to lower inflation, but it wants to do that without creating a recession. So only a year ago, our interest rates were at almost zero. They were stimulatory for the economy. And after 10 interest rate rises, they're now meant to be slowing down the economy. It's a bit like Goldilocks and the Three Bears. You don't want things too hot or too cold. We want them just right. And just when Dr. Phil thought he got it right, we had the latest employment figures come out. And it must have concerned him as Australia's job market showed little sign of slowing in March, despite almost a year of interest rate rises. An estimated 53,000 jobs were added to the economy in March alone, and unemployment stayed at near 50-year lows at 3.5%. And while inflation is falling, the fear is that if unemployment doesn't rise substantially, or a little bit at least, inflation is going to remain sticky when the Reserve Bank is trying to target it to get down to between 2 and 3%. Right now it's about 6.8%. Now, of course, if you've been watching our weekly commentary, you'd know that while Dr. Andrew Wilson saw the April rate pause as positive for our property markets, he also warned last week that it was going to be more likely for us to have more rate rises to come. So to get an understanding of what this week's economic news means for our economy and our housing markets, I'm looking forward to my weekly chat with Dr. Andrew Wilson, Australia's leading independent housing economist and chief economist of My Housing Market. Hi, Andrew.
Yes, good day, Michael. It's always interesting to read the tea leaves or whatever it is, that we read. Not sure what the RBA is reading, but their surprising, astonishing, whatever you want to call it, decision to leave rates on pause, which is a good thing for consumers. Let's not quibble. I'm not sure what data they're using to support the hey, let's wait and see if it's working type scenario that they promoted as being the reason for putting rates on hold. But the latest data, once again, is a bit of a slap in the face for the Reserve Bank and its sort of analytical process, which is all about month in, month out. Oh, we're only going to respond to the data. We're waiting for the data to come along. We'll make decisions based on the latest data, etc., etc. Well, the latest data is completely the reverse to what I would expect the Reserve Bank would be hoping, and that was that we would be seeing some signs, at least, of a slowdown following what was 10 consecutive months of interest rate increases. And the proposition that there are, lags involved here, and that's fine. Well, we've had 1 month off now for interest rate increases. We've got our March unemployment data out, which is spectacular again. So I'm not sure how long the Reserve Bank is prepared to wait to see if it's working. But certainly the latest data shows it's not working. So given their theoretical position on monetary policy, you would expect rates to start to increase again. And of course, then we're going to have the spectre of another flip-flop from the RBA. So it's going to be very interesting going forward, Michael. And it's not just those, I guess, a little bit lagged labour market data, which the latest data is for March, but it's also those weekly housing auction market numbers that are continuing to rise now towards clearly what's looking like the emergence of a seller's market again. People are buying not just retail, but they're buying big ticket items such as housing again. I just can't figure out the Reserve Bank's stance on all this. And to say that inflation is falling, hey, it's great. It's only 6.8%. Let's celebrate. Are you kidding me? The target's 2 to 3%, Michael. We're light years away from that at the moment. Now, reduction in inflation's really been about the readjustment to the supply constraints that we had that were created through COVID. I think it's still a journey before we get back anywhere near that 2 to 3%. And I think that journey is going to mean higher interest rates and other mechanisms, well, particularly interest rates anyway, to quell demand. But no sign of that in any sense at all at the moment, Michael.
Well, there's not the jobs data, and clearly the property markets are turning the corner as well. Well, some segments of them are, and that's not going to be good for inflation. Rents are clearly going to keep going up, as we mentioned each week, and so are property values. But let's just dig a little bit deeper into the unemployment figures.
Yeah.
Your chart here shows that, if we go back on your chart way back to 2008, we've never experienced figures like this before.
Yes, another 3.5% unemployment rate, Michael, over March. That was the same as that we had over February. And this is the lowest monthly unemployment rate on record. Well, we have to go back to the early 70s. And of course, the market and the economy and society was a completely different kettle of fish back in the early 70s. Gee, that is a long, long time ago, Michael. So, unemployment rate, another record low over March. When we look at the backdrop to the numbers, that unemployment rate, record low, but we saw also another increase in jobs, Michael, up by 53,000 over the month. So we created 53,000 jobs over the month, still holding a record low unemployment rate. The number of unemployed was down again. And let's remember that February we created over 60,000 jobs. So these are back-to-back big numbers for job creation. The number of unemployed was down again, down marginally, about 1,600 fewer unemployed. But again, that followed a sharp fall in the number of unemployed over February. And the participation rate was steady at that very high 66.7%. Michael. So it's not a case of a lower unemployment rate because people are leaving the workforce. We still have a very high participation rate. Of course, that's the proportion of the population in work, and they're all finding jobs. Does it get any better than this? And when we look at the state breakdowns in terms of the unemployment numbers, only Western Australia has shown an increase over the past year in its unemployment rate over March, and it's still the second lowest in the country, 3.6%. But the New South Wales unemployment rate, 3.2%, Michael, another clear leader, another month of clear leadership from New South Wales in terms of the strongest local economy. No surprise that Sydney market is starting to look like it's on the road to another boom, maybe. Part of that driving force is the very, very strong New South Wales and Sydney economy. So I'm not sure we have any real signs there of slowdown at any level. You just couldn't have really and logically a stronger month in terms of March for the labour market. And yet we had the Reserve Bank decide, oh, no, let's wait and see because there might be some sort of lagged effect occurring because of higher interest rates. So how long are they going to wait for this to appear? And does it mean that while they're waiting, this booming economy will just create more energy for inflation?
Well, clearly one of the factors affecting unemployment is how many people are looking for jobs. That's one of the reasons they've upped immigration. The floodgates opened a while ago. People are coming in. It doesn't seem to have affected the employment figures, Andrew, but it clearly has affected our housing markets with nowhere for all these people to live.
The capacity, the infrastructure to match these hundreds of thousands of new entrants into Australia, new residents into Australia, be they permanent or temporary, as in students, is only going to create upward pressure on prices, particularly property prices and rents. And I think we're seeing that occurring now. And, there's no sign that the high number of migrants that are coming into Australia currently and have been doing for now the best part of a year are having an impact on the labour market. So it's a great economy. It's super strong. It's a great economy for workers. Wages are rising at the highest levels in a decade, but we've also got the highest inflation in 30, 40 years, and really no significant underlying improvement in inflation at the moment. So we keep our fingers crossed that that will start to occur going forward. I think the real pressure's on the Reserve Bank. Which way do they flip? Do they flop this time?
Well, one of the other things we keep a track of is building costs,
Yes.
because that flows into our property markets. We know that building costs have gone up a lot over the last couple of years and caught a number of good builders by surprise, where they got caught out getting locked into fixed price contracts they couldn't complete. What that's meant is a number of builders have unfortunately gone broke. That's left some consumers in the lurch, but it's also put extra pressure on supply of our property markets. But what were the latest Australian Bureau of Statistics figures? And I know My Housing Market keeps a careful check on building costs. What's happening?
No real relief, Michael, with the latest data, which is the February building approvals data, of course. Seeing a slight decline in the rate of growth, but it's still stratospheric, if I could say that, very high growth levels. This, of course, puts builders under pressure because typically it's a very highly competitive industry, particularly house building, Michael. Builders work on lowish margins, narrow margins. Of course, contracts are mainly fixed price contracts. So builders do become exposed when there is movement upwards in building costs. But the movement we've seen since that home builder policy generated all that demand back in early 2021, we've never seen building costs in terms of a natural outcome increase at this level. And we're continuing to see those. If we look at the My Housing Market Building Index, it's still rising. And it's interesting to look at the index prior to that home builder stimulus package of 2021. You can see how flat building costs typically were, Michael. That's what makes house building profitable, because building costs rising by, a couple of % per year. And that meant that builders could manage their profit expectations and outcomes. But of course, how do you absorb these ridiculous increases that we've had and are continuing to have over the past near 2 years? When we look at the actual rate of growth over February, the annual rate of growth, and this is measuring quarterly building costs, Michael, so it's a reasonably robust measure. But of course, the reason we look at quarterly is because it's the quarterly CPI data where this building costs influence. And even though we do have a monthly inflation model now, we are going to get out this week the latest March quarter CPI data, which will be, obviously, given the issues with the Reserve Bank and interest rates, will be closely watched. But that data, again, as we can see with the rate of growth, will be significant in terms of the impact on building costs on inflation, which the latest data shows that annual inflation on that quarterly index is still higher by 16.7%. And even though it's declining and it is the lowest rate of growth that we've seen since last year, it's still obviously something that's unsustainable, particularly from the point of view of a home builder. How do you absorb those sort of increases that are continuing and still make a profit? I've also placed, just for some interest, Michael, the relative position of each of the capital cities in terms of their house building costs. We can see there that Sydney's the clear leader. High price Sydney, no surprise there to some degree that it costs more to build a house in Sydney because houses are typically more expensive and therefore more is paid for them for new houses. And that means land is more expensive. But clear leader there, Sydney, in terms of the average house building costs over February quarter. Number 2, Melbourne, again, no surprise being the second highest price for houses, that Melbourne market. But Darwin there, number 3, which is, again, reflects the high cost of building in Darwin. But all capitals reported an increase over February, with the exception of Sydney, where there was some relief with costs marginally lower. But I think when we look at the big picture in terms of how building costs have moved over the past 2 years, particularly, you can see that Brisbane has had just a spectacular growth where house building costs, Michael, in Brisbane have increased by 44.3% over the past 2 years. So no wonder it's a number of those Brisbane home builders that are finding it a little bit difficult to continue to trade at the moment.
Now, even if house building costs stop rising, that doesn't mean they're going to fall anymore. They're just going to stop rising. Yes. And that means the cost to build a house moving forward is going to be 30-40% more than it was a couple of years ago. And that's one of the factors that's going to underpin our property markets. Yes. It's also one of the factors that's making new development not feasible at the moment. They're not really financially viable.
Yeah, that's right, Michael. And this is the problem. It never rains, it pours, does it? And we've got all this demand coming through, as we mentioned before, with migration particularly. We've got a regeneration, a revitalisation of our housing markets as consumers now move back in, particularly those consumers that are recognising that there's still very good value in the market, particularly Melbourne and Sydney at the moment. and they're a little bit of that FOMO starting to rise again. But just when we're, getting all this demand in what is already an undersupplied market, we now have this conundrum of high building costs, which are only going to mean fewer homes are actually completed or even started. So those building approval numbers, which are falling still overall and are significantly lower than where they were 4 or 5 years ago, even then those approvals, many of those won't become commencements. So the proportion of commencements to approvals will start to fall, which is fewer houses, which only mean fewer choices, which will only mean higher prices and particularly higher rents.
I just wanted to interrupt this week's Property Insider Chat to remind you that this is not specific property advice because we don't know your personal circumstances. But if, like many property investors, you're wondering what's the right thing to do at present, should you buy, should you sell, should you wait, you can trust the team at Metropole to provide you with direction, guidance and wealth-producing results. Whether you're a beginner or an experienced investor, at times like we're currently experiencing, you need an advisor who takes a holistic approach to your wealth creation, and that's exactly what you get from the multi-award-winning team at Metropole. We help our clients safely grow, protect and pass on their wealth to future generations through a range of services: strategic property advice, buyer's agency, wealth advisory, property management, renovations and development management services. Go to metropole.com.au and explore your options with a complimentary clarity consultation. Well, over the weekend, we were back at looking at auctions again after the Easter break. And even though the total number of properties for auction wasn't as high as before, end results showed the depth of the market. There were people out there wanting to buy.
Yes, Michael, a very big weekend on the comeback trail there from the holiday the previous weekend. Of course, Easter break, we had virtually no auction action at all for a fortnight. Certainly nothing over Easter, but markets came back. Good numbers of auctions, certainly a reasonable test. Over 600 auctions in Sydney and Melbourne. The same weekend last year, Michael, was the Easter weekend, so we don't have those year-on-year comparisons. But when we do look back a year ago, clearance rates are now starting to move ahead of where they were a year ago, Michael, particularly in Sydney and Melbourne. And I think that says it all. And we're now well and truly in the mid-70s, can you believe it, for auction clearance rates. Again, higher than we had over the pre-Easter Super Saturday. It's interesting when we look at the numbers in a little bit more depth, Michael. The breakdowns, particularly in Sydney and Melbourne, there was still a higher proportion of lower priced and mid-priced properties in the market on the weekend, which shows that the higher priced markets are still in holiday mode, which is what we see. So they're still taking holidays. And over the next couple of weekends, although we do have the distraction of Anzac Day coming up, Michael, but over the next couple of weekends, we'll get a much more robust proportion of the market in terms of all price ranges. Particularly, as I said, the medians in Sydney and Melbourne were down. But that's the impact of the holidays still on higher priced properties, still not part of the market, but they will start to return as those holiday makers come back over the next week or two. But inarguably strong results, Michael, to come back, very strong rebound. Again, it's showing that even the bottom part of the market, mid part of the market, is finding plenty of buyers, and maybe that's that value proposition. And the value proposition is, when we look back over the year, we can see just how strong Sydney and Melbourne are tracking now compared to a year ago. They are higher than a year ago. Brisbane's even picking up its performance and is around about where it was a year ago.
A year ago, the interest rate rises hadn't started. People were feeling so positive at the beginning of 2022.
And we're at the back end of the boom. So, as I said, these are remarkable results. And the Canberra market also is picking up, and it's still a long way behind where it was a year ago. And that's really the only significant underperformer is the Canberra market. But they've had some changes to property policies in that local jurisdiction there. And Canberra typically follows the Sydney market upwards, and it'll be interesting to see if that pattern continues. So no doubt that it was a strong return from holidays, even though it's not the full return yet, Michael. This last weekend and over the next coming weekends, I think we'll continue to see strong clearance rates. And there's a real sense, I think, particularly in Melbourne and Sydney, that opportunity is knocking, and that with prices still below where they were a year ago, but rising, as we've shown clearly with our data, that if you're looking to get some value from property, now's the time to move. And I think this is what's driving these quite strong clearance rates.
Well, the property market's driven by consumer sentiment and supply and demand, and clearly buyer sentiment has turned, but we've often said how quickly that turns. And if we're in America, we'd say it turns on a dime, wouldn't we? But seller confidence takes a little bit longer to turn until they're comfortable, hey, it's a good time to sell. And then it takes a period of time before they put their properties on the market, get them marketed, get them to auction. So I see we're in this window of opportunity, this little squeeze at the moment where buyers are back and there isn't just enough good stock, Andrew.
Yes, but most buyers are sellers and sellers are buyers, Michael, as we suggest, and it swings and roundabouts. People just don't come out of nowhere except unless they're first home buyers and they just take relief out of the rental market. But most people who are selling a house are buying a house too, and vice versa. So it's all part of the same energy.
So the cycle is moving on as it always does. Now the Australian Bureau of Statistics is going to bring out their CPI figures in the middle of next week. So it'll be interesting to see. Look forward to catching up with you and hearing what's happened in the property markets over the last week then.
Thanks, Michael.